Hello, all. Welcome to our podcast, Everything Tax. Today, we have a very special guest, Dr. Joshua Bamfo. Dr. Josh, as we call him lovingly, is the transfer pricing head of our Africa, Middle East, and Asia practice. And I'm so pleased that I can pick his brain and get his thoughts on some transfer pricing intricacies and some concepts. Dr. Josh, welcome.
Thank you, Pratim, for having me.
So, Dr. Josh, everyone, I think whoever's listening in is aware that the law is new, corporate tax, and with it, was legislated transfer pricing provisions as well. And, while this region is adapting to tax in general as a whole, with VAT coming in, corporate tax, I think transfer pricing has been a topic which has been, I would say, difficult to digest for certain businesses because, it asks businesses to, suddenly change the way that they operate or they're doing business across the region. And I want to touch upon one very specific kind of transaction, which is intergroup financing.
Yeah.
Because of how businesses are run in UAE, there's a lot of borrowings or, cash just being, supplied from one entity to the other entity. So just a general question that, does all these financing require an interest to be charged? And, if yes, then what are the, kind of intricacies that businesses need to look at?
All right. Thank you very much. So the financial transaction is one of what I call the four broad transactions that fall under the purview of transfer pricing. Yeah. The common one is tangible goods, purchase and sale. Then there are services, then there are intangibles, then there's financial transactions. Now, when we come to financial transactions, the common financial transaction is a common, loan transaction, right? Yeah. Where one company, which is part of a group of related parties, makes some funds available to a related party, all right? And it's expected that you charge some interest rate on that loan. Yeah. Because the whole concept of transfer pricing is to treat your related party as if it's an independent party. And there's no way you will make funds available to an independent party and not charge a commensurate interest on that loan. Yeah. So that is expected, right? The challenge will be demonstrating to tax authorities that that interest rate that you charge is fair or reasonable. Yeah. All right. And there are a number of things you need to consider. First and foremost, you need to look at the attributes of the loan, right? What currency is that loan being given? Because if it's a local currency and that currency is deemed volatile, then there's some risk in terms of its payment, and that has to be captured in terms of your determination of the risk premium you're going to add over and above some base, Then there's also the credit rating of the borrower, all right? Yeah. So if there's information about that credit rating and that credit rating is deemed to be poor, then you're going to charge a higher premium because of the possibility of default, so that has to be considered. And then the tenure of that particular loan, how long is it? Is it a medium term? Is it a long term? All those things have to be factored in. And then you need to then determine what that reasonable interest rate is. So that is pretty straightforward in terms of its understanding. All right, and if you can find a comparable loan that has been made with or from an independent financial institution such a bank with similar, attributes, then you can use that interest rate as a benchmark. All right, so that is basically how you deal with that. But there are other financial arrangements that are a bit different from this traditional loan making. One of such could be cash pooling, right? Yeah. And cash pooling will be a case whereby you have a group of entities. Could be the same business, different businesses, could be like a conglomerate. You have some that are seen as cash cows where they have more cash, and others might have a need, you understand me? Rather than, those having need to go to an independent or third-party bank to borrow, given the complexities of borrowing and the, ancillary charges, the group can actually decide to have an internal cash pool where you have excess cash, you put it in that pool, and those who have a need will borrow from it. Yeah. Even with the cash pooling, there's expected to be some interest that those who have the excess and who place it in the cash pool earn. Because if I were to put those cash in either a savings account or some term deposit account, I would definitely earn some interest. So the opportunity cost of putting my excess funds in that cash pool will be the interest forgone if I put it in, some form of account with, a third-party bank. So some interest is expected to be earned when I'm the one making the deposit, right? If I'm the one taking out the loan, borrowing, I should also pay some interest for borrowing from that particular cash pool. However, what we are going to be able to eliminate will be some of the bank charges that would have occurred if I'd gone to a third-party bank as opposed to being part of that cash pool. So that's another element that you typically see. Another aspect of such is usually you have a treasury department or a treasury function that is helping manage those, either borrowings from third parties or managing the cash pool or what have you. So that treasury function is some administrative function that needs to earn some return, right? So there's an expectation that if you have a treasury department or a treasury entity that does some significant work in terms of managing the borrowings and lendings of loans, they get some return for their treasury or administrative function. So that's another aspect.
And they could perform cash pooling as well.
Exactly, they could perform that. So that is expected, and that return could be different from what you see on the interest rate per se. You understand me? Then the other element that comes out from time to time are corporate guarantees, right? So what you might have is that either you might have the parent company, which is a cash cow with a very good balance sheet, or it could be an operating entity, which is a cash cow with a very good balance sheet. And a subsidiary or one of the group entities wants to have a loan, right? But if that entity should go directly to a third-party bank, either they are not going to get that loan because their balance sheet is not good. Or they might get it, but at a very high interest rate because their financials do not look good, right? So there could be different reasons.
This is a very common phenomenon in this region where, Dr. Josh, that where you have a very strong balance sheet at a holding level.
Exactly.
But the subsidiaries are not very strong.
Exactly.
And you have not only corporate guarantees going around, but you also have personal guarantees of the owners. So, this is a very common phenomenon, and I would like to get your thoughts on it.
Exactly.
Some people are of the view that personal guarantee is more of a shareholder function. And you need to and what constitute actually earning a guarantee fee versus shareholding function, because as far as my experience tells me that shareholder function is it's a fine line. Not everything can be a shareholder function. So what are your thoughts on it, Dr. Josh?
So I think the corporate guarantee is much clearer, right? And let me touch on that first, then I come to the shareholder function. So once another legal entity within the group guarantees on behalf of another group entity, what is done is taking off some significant risk, because anytime you default, is that company that has guaranteed that has to make up for whatever you owe. And there's no way I would take on such a risk if you're an independent party without expecting some return, right? So there's an expectation that there will be some guarantee fee. The challenge has always been the determination of the reasonableness of that guarantee fee, and there are different ways you can go around that. Now, on the shareholder side of things, right? So if I'm a shareholder, right, or I sit on the board, or whatever it is, right? At the end of the day, a shareholder can be a passive person, right? He's not active in the business. So, but let's say you either sit on the board or you're a major owner of it. See, if you take on that risk, you are being treated. You have to be treated like an independent party taking on that risk, because there's no expectation that if you sit on the board or you're a shareholder, you have to take that additional risk of guaranteeing, the payment of funds by that corporate entity. You are separate from that particular corporate entity. So if you were to take that on that risk, there's an expectation that they treat you like an independent party, and you need to earn some return. So the question always goes back to, how do you make a determination of a fair guarantee fee to charge the company you're guaranteeing for? You understand me? So I think that is more of the challenge. But anytime an individual corporation takes on that significant risk of guaranteeing that, look, should this entity or this individual default, I'm going to take it on. Right? That's significant
a risk for which you need
exactly. You need a return. So for me, that's pretty clear.
So one very important question, Dr. Josh, is that when you spoke about intercompany borrowings or financing and even cash pooling, right? So in UAE, what happens is sometimes those borrowings are given to other jurisdictions. Now you charge an interest. Suddenly you start charging an interest to them. A jurisdiction will suddenly see a cost or an expense hitting their profit and loss account. One worry is that how would other jurisdictions look at it? And what has your general experience been that, and one very important point is, while you're looking at it from an income perspective in the UAE, but the expense side also becomes very critical.
Exactly.
And you must do a due diligence of that local law as well, right?
Exactly. So there are a number of issues that comes up when it comes to intercompany loans, and especially if the borrower is in the offshore entity. So let me look at it from an African perspective. So let's assume that you have a subsidiary that actually operates in Africa, and the parent company is in, let's say, UAE, right? And makes a loan to the subsidiary here in, let's say, Nigeria, for example, right? One of the things the tax authorities look at is even beyond, they call the substance test, right? Even before you look at the reasonableness of the interest rate, which is the price of the loan, the question is, does the subsidiary actually need this working capital, right? Because the concern is that, and that's the reason why the base erosion and profit shifting exercise looked at interest rates as one of the things that they need to look at, because they know that businesses use interest payments as a means of shifting profit, right? Because
it is a low-hanging fruit.
Exactly, because interest expense above the line, it reduces your taxable profit and the amount of taxes you pay, and so they usually try to do some form of substance test. The challenge, and so first question, what was it used for, or was there a need? And that can always be established because usually it's for working capital need. The next question sometimes they ask, even though some of these jurisdictions do not have explicit thin capitalization rules, is to see whether the parent company has funded, the local entity adequately before lending to them. You understand me? Because they look at the capital structure. Now, in some jurisdictions, there's thin capitalization rule that gives guidance in terms of the debt to equity ratio of your capital structure. And that gives them some comfort that, that company is not over leveraged, or you've not pumped a lot of debt just to take money out of the jurisdiction. So in Nigeria, they don't have thin capitalization rule, but they will still ask that, right? So if they feel like, the parent company did not really capitalize that particular company enough, and they are just using debt, to put them, at a lower profit level, then that could be an issue from a substance point of view. But once the substance has been established, then the next question is whether the interest rate is reasonable or not. Obviously, your risk exposure from the borrower's perspective is whether that interest rate is high or not, right? And one of the interesting things that we've seen is that, yes, if you had a situation whereby, that entity borrowed similar loan with similar attributes from a third-party bank, all right, can then compare those interest rates, right? But sometimes that doesn't exist, So then an analysis is done, and sometimes you see a country risk premium, right, being added, So the whole idea is that, yes, we've looked at the credit rating of the borrower, we've adjusted for potential default, but even by virtue of the fact that you are operating in a country or jurisdiction where there are political risks, there are different risks that could affect my ability to get my cash back, all right? I have to factor that as part of the risk premium on the interest rate. That is one area that there's been a bit of a pushback from the tax authorities that, hey, why are you charging a country risk premium? Interestingly, when it's the other way around sometimes, we've seen instances where the tax authorities have also invoked this whole concept of country risk premium to inure to their benefit. So the concept...
From an income side.
Yeah, from an income side. Say, hey, there's so much risk here, so there should be some premium. So really, it tells me that they understand that country risk premium is a legitimate, risk that has to be considered. The question is the quantum. You understand me? But sometimes they try to rule it out entirely that, look, I don't see the reason why, if you thought that there was a country risk premium that had to be paid, you should have gone for the loan locally. There are banks out there, that kind of counter argument. But those are some of the nuances that tax multinational enterprise need to be aware when you are pricing the interest rate on these loans. But by and large, they are receptive to the fact that interest has to be paid. But you need to demonstrate the reasonableness of that, and make sure that it's not excessive. Because if it's deemed to be excessive, then you know that there's going to be some disallowance. Now, with the BEPS issue on interest payment, once it's seen as excessive, that you might not be able to get full tax deduction for your interest payments. You understand me?
Yeah.
So those are some of the issues that we need to be aware from the borrower's perspective that the lender has to be aware of.
Very interesting point on the country risk factor, because I'm aware that a lot of UAE groups have investment in Africa, and sometimes repatriation becomes a grave concern for them. That pulling out money and getting that money into UAE becomes risky. So this could be a potential point of litigation. And as usual, transfer pricing has to be a fine balancing act.
Definitely, it is. It is. You need to really manage those risks, but there's some economic rationale behind some of this risk premium, right? It's just a matter of how do you articulate it, so it's convincing. And even if the tax authorities do not agree, but an independent court can understand the business rationale, commercial rationale for such a charge, that's for me is the litmus test, right? It's not just what the tax authorities will do, because they'll do anything to maximize their tax revenues anyways.
Of course.
Yes,
so UAE may not challenge you much if you're from an income side, but from an expense side, it could be challenged.
Yeah.
So Dr. George, just moving on, I'm getting to documentation, specifically local files. Now, sometimes, clients, or our targets don't fully understand the concept of a local file in terms of how important it is. Right? How important documentation it is. Sometimes we hear feedback that documentation, just having a copy of the invoice, I'm charging my third party, I'll just keep the purchase order and I'll show this purchase order to my tax authorities, and that's it. I've done my benchmarking and I've had my documentation. Then we get into a whole explanation as to there is a format and this will be a defense document, right? Ultimately. So Dr. George, just want to pick your brain as to, in your experience, you have more than 2 decades of experience. How important is it to have a robust local file?
Thank you very much. This is a very important question, because many a times, clients who are taxpayers see documentation as a nuisance, right? And understandably so, because it's not their core business, right? So it's just a compliance requirement, and it's something that I need to tick the box. So really, they cannot be excited about it. So the lesser, they spend time and resources on it, the better for them. But it's our responsibility as advisors to really explain to them the benefit of having a robust TP documentation. First and foremost, it's important that we recognize that transfer pricing is one of the riskiest areas of taxation. In fact, UI conducts some survey globally, and they focus usually on US multinational enterprises. From time to time, they ask a simple question to CFOs: what is your biggest tax risk area? And transfer pricing is usually number 1 or number 2.
I think it would be number 1 in most countries.
Exactly. I mean, it's usually number 1, number 2. It's only number 2 when there's going to be a change in tax legislation and they don't know what direction it's going to go. But once those changes have been made and people become familiar with it, it's always transfer pricing. Because, it's a highly contentious area. The concept of arm's length principle is sound technically, but in practice, there's a lot of freedom, It becomes more of an art than a science. And also 1 + 1 is equal to 2.
It's an economic concept.
Exactly. It's like a social science. So because I can take a position and believe strongly I'm right, and tax authorities will take a different position and believe that they are right, there's always going to be contentions and there's going to be dispute, and it has to be resolved one way or the other. Now, with that at the back of your mind, the first question you need to ask is, should there be a dispute? Which 99.5% is going to be a dispute with your tax authorities. All right. How am I going to defend this in a manner that is convincing, first and foremost, to the tax authorities if it doesn't succeed, and to the courts? And your first line of defense is always your TP documentation. So if you have that in mind, then you have an incentive to make sure that my TP documentation is robust, because I'm already anticipating years down the line potential dispute and the possibility of me litigating if the tax authorities do not agree to something that is win-win for both of us, right? So if you have that in mind, then you know that I need to pay attention to the robustness of my TP documentation. Having that in mind, then you need to ask yourself, what makes a robust TP documentation? All right. First and foremost, there's guidance in the OECD guidelines in terms of what goes into it. All right. And secondly, you need to ask yourself, what am I trying to convince tax authorities about, right? That my transactions were conducted in a fair and reasonable manner. depending on each transactions, the arguments might differ a little bit, and the things you need to prove and the methodologies and all that. But what we need to recognize is that, yes, there are methods, but it's fact intensive. Being able to develop the facts about your business, what drives value, the nature of the transaction, who does what, that's the functions, risk, and assets, and all that are critical. All right. So you cannot just take an invoice and think that, the invoice shows that the transaction occurred. That is more of a substance issue, Or an invoice, this was paid, right? Okay, they did occur. But they're convincing me that, okay, what was paid was fair and reasonable is a whole different argument. You understand me? So once they have that, I think it's important that taxpayers, CFOs, tax directors, tax managers understand that it goes beyond invoices. You need to have a robust TP documentation that is fact intensive, that speaks to the issues, well documented, and that supporting documents beyond that report that should support your analysis. That's where the invoices come in. That's where the agreements come in, and all those are supporting documents, not the document in itself. You understand me? So the whole, the report and those documents then forms your TP documentation, and that has to be very robust and defensible. I mean, we've gone through, even when you have a robust TP documentation, you might not necessarily, win when you go against the tax authority, but the objective is different, is to maximize tax revenue. But it's a starting point so that your chances of winning down the line is enhanced.
Yeah, and I have a similar experience, where, I had past experience in India. Same thing. If your local file was not up to the mark, you would lose.
Exactly.
More likely.
No, that one is easy.
Yeah, it's easy. Even the courts used to not entertain you much. So it used to get very difficult. And it's a very important point. I think it's very fact specific and fact heavy driven. And very interestingly, when we framed policies recently for groups, sometimes we got feedback from CFOs that, oh wow, we did not know this about our business.
Exactly.
So it's good learning actually, and it's an evolving law.
That's it.
So Dr. Josh, thank you for being with us for this podcast. Thank you all for tuning into our podcast. Do remember to subscribe to our channel in YouTube. We're also on Spotify. Rely on Andersen, elevate your business.